Good afternoon. Okay. Good afternoon, everyone. Okay. Good afternoon, everyone, and thank you for joining us this afternoon to share everyone. Can yes, okay. So, good afternoon, everyone, and you are welcome to today's down on impact of capital gain tax your investment. My name is Sunday Amusu. I'll be moderating this webinar. As an investor, there's a need for us to understand the implications of capital gain tax on all our investments. So we need to learn on all our investments. Is crucial for us to make informed decisions and maximize our return. So the goal of this webinar is aimed to provide insights to how capital gain tax affects your investment strategies for maximizing your tax, minimizing your tax liability, and expert perspective on navigating this complexity. So we have a distinguished speaker that will be doing justice to the topic, giving us insights on how capital gain tax will affect our investment going forward. So it's my pleasure to introduce to Ross.
Hello, can you hear me? Hello, can you hear me?
We can hear you, sir.
We can hear you, sir.
You are live.
Okay.
Thank
You can
sir.
see me too.
Yes, we can. We can see you, sir.
Okay.
Yes, sir. So good afternoon, everyone. Good afternoon, everyone. Really appreciate your time out with us this afternoon. You see the silence? That is silent. So good afternoon, everyone. I'm so sorry for that mishap. So good afternoon. Thank you for joining us on this for this afternoon. And you are welcome to today's webinar on impact of capital gain on our investments. My name is Dewato Sunday. I'm also an authorized mentor and also an associate member of Startup Institute of Salvation and also an associate member of Startup Institute of Stockbroker. So I'll be anchoring the webinar this afternoon. As an investor, there's need for us to understand the implications of capital gain on our investments. It's crucial for making informed decisions and maximizing our return. So the goal of this webinar is to provide insights into how capital gain tax affects our investments, strategies for minimizing tax liability, and expert perspective on navigating this complexity. So we have an expert and a seasoned, well-rounded on tax issue to be doing justice to the topic this afternoon. So with my pleasure, I will be introducing Mr. Emmanuel Ogiga. He'll be the one speaking as a guest speaker on this webinar today to give us insight what we need to do, how we need to plan ahead for the new tax law that will be starting January 2026. So a brief background introduction for us to have the understanding of the speaker, his background, his wealth of knowledge as regards tax. So Mr. Emmanuel holds degree in accounting from the prestigious University of Lagos. He's a fellow of the Institute of Chartered Accountants of Nigeria, ICANN. He's also a member of Chartered Institute of Foundation of Nigeria, CITN. He's also a registered carpet capital market professional with Nigerian Capital Market Institute, and arm of SEC. Is an experienced professional who has worked in financial consulting, real estate, healthcare, manufacturing, financial technology space. He has facilitated training at accounting clinic organized in conjunction with Lagos Business School alumni. He is the engagement partner at Benga, Vivajo, and Hope, and is also known as GBC of WIGA. So with my high pleasure this afternoon, I welcome our speaker, Mr. Emmanuel. You are welcome, sir.
Thank you very much, Mr. Taufik. I'm glad to be here, and thanks to Lead Capital for inviting me to anchor this section. I would go ahead to share my slide now. Mr. Taufik, can you confirm that you can see my screen? Mr. Taufik, can you confirm that you can see my screen? Okay, thank you very much. Currently, we are in times where tax compliance, regulatory compliance is heightened. We can see from the current regime is trying to block all loopholes that leads to short fall in its revenue generation. And capital gains tax, as well as other taxes, has been reviewed, and certain changes came into play with respect to the Nigerian Tax Act that will be coming into full effect on the 1st of January 2026, following the sign-off by the president. It's nice to know that this emanated from the presidency, so effectively it's more like an executive bill that now a law that is trying to change the landscape of tax compliance and regulatory compliance as well. I'll just go through what this slide will contain in terms of its learning objective and what the tax.
Continue, sir.
Like I was saying, over the years, capital gains tax is not new to Nigeria. It has gone from 20 to 10% at the point following the when it was signed into law 7 years after Nigeria's independence. We'll look at that as well. We'll also look at an overview of the new Capital Gains Tax Act. Really, this tax used to stand on its own before it was repealed by the NTA, the Nigerian Tax Act, and it was integrated fully into the respective areas for corporate and personal income tax, because this tax type would be remitted by corporate and individual taxpayers. We'll also be touching on that. We'll look at also compliance strategy, exemptions in the law, which for players in the capital market industry needs to watch out for and guide against, because everybody comes into this market for a specific purpose, for returns and for capital appreciation. We also look at the implication for investor as well as capital market operators. So one day you are when your broker or your provider that provides the platform is charging certain amounts that remits to the government, you also need to know about that. We'll also discuss around scenarios really for individuals, for corporate traders and investors, and how you can approach investing in 2026, because effectively the Nigerian Revenue Service, which is currently the Federal Inland Revenue, would now take the name of Nigerian Revenue Service, and the law itself has given the Nigerian Revenue Service a whole lot of power to integrate data. And we'll also be looking at that as well, how it comes to play, because you might think that the government do not have So also we'll be looking at recommendations as well. We'll be giving recommendations to you on how you go about trading in the capital market space, because there's a whole lot of opportunities as well as challenges in the capital market space. So capital gains tax was introduced in Nigeria by the CGT Act of 1967. This was basically 7 years after Nigeria uh, got independence from its colonial master. So basically, this capital gains tax is not new to Nigeria. It aimed to tax profits and gains arising specifically from chargeable assets. And the definition of chargeable assets in the previous law really was restrictive, in the sense that it did not include some couple of non-traditional instruments that we have in the market space currently, like crypto, coins, and a whole lot of digital instruments that we have. So this new Nigerian Tax Act, which has integrated the various taxes, really covered all those, including even trading in foreign currency as well. So if you trade in foreign currency, crypto, and other digital instruments, it's expected of you to comply and file your returns accordingly. So the government has looked at the capital market space, even though it has tried to, give it some sort of soft landing by providing exemptions and suspending some sections of the previous Capital Gains Tax Act, like the exemption from VAT on capital market transaction and a couple of other instruments that it was exempted. Now the government has fully returned those parts, charging value-added tax on capital market transaction effective in 2024, following the expiry of the 10-year exemption that was given during Dr. Okonjo-Iweala. I think it was during the time of President Obasanjo that this came. So over the years, the government has been looking for how to improve its revenue, and basically bringing about the new Nigerian Tax Act, which covers capital gains tax and a whole lot of other areas. So if you look at in 1967, the CGT was 20%. It moved to 10% in 1984. And in 2004, it came down to 10% as well. Between 2020 and 2021, the Finance Act as well also tried to bring in some modifications. It's interesting to know that some corporate players in the industry have actually been complying with paying taxes of 30% on capital gains. And why do I say that? Investment companies that trade and make gains on the instruments traded on the floor of the stock exchange and any other exchange as well really would have paid 30% company income tax, which is almost the same thing as the 30% capital gains tax. So retail investors, like individuals, really has not been making this remittance and compliance. So the government is looking to ensure that across board, these taxes are fully paid by both corporate and individuals. So over the years, exemptions were granted, especially on gains on disposable securities like on shares specifically. So over this period, a lot of investors, especially foreign portfolio investors, came into the Nigerian jurisdiction and sort of gain from tax arbitrage. Basically, a whole lot of countries in Europe and the Asian countries and regions usually charges capital gains tax on share instruments. So a lot of foreign portfolio investors came into Nigeria to trade and make some profits and move to other regions. This also improved our volume and scale of the operation of our capital market. So on the 26th of June 2026, the president signed the Nigerian Tax Act. This Tax Act repealed over about 12 laws, company income tax, tertiary education tax, including the capital gains tax. It was now infused and integrated into the Nigerian Tax Act. So when you go through each part and section, you see the respective responsibilities and obligations of every taxpayer in the country. So this basically was to, improve revenue and eliminate the tax arbitrage, which I talked about earlier, where for foreign portfolio investors move their funds around jurisdictions where there's an advantage in terms of tax. Like if you look at Mauritius currently, Mauritius does not charge foreign portfolio investors capital gains tax. So they are more like a country that is open to receive foreign portfolio investors as well. So basically, the government was looking at modernizing tax administration, improving its revenue across board. And in recognition of this, the executive, in its own understanding, put together a committee that reviewed all these vis-a-vis other regional countries in Africa to ensure that capital gains tax came into play fully, especially for individual taxpayers. So the Nigerian government is also working to, ensure that infrastructure in terms of technology that enables the full implementation and tracking of transactions are done as well. Because for individuals, the obligation is to the respective state's internal revenue service and not to the federal inland revenue, while for corporate traders in the market is to the federal inland revenue service. So let's look at the capital gains tax framework generally. Looking at it from the old framework, initially it was 10% on capital gains. And like I mentioned earlier, the previous CGT was really focused on very specific and few collection of chargeable assets, things like movable assets, share, and a couple of other assets, that you could trade in and make a gain on. It was really simple and structured and straightforward. The reliefs were there and the exemptions were there. And basically it was, designed to protect smaller players in the space. Retail investors with transactions below 100 million were exempted from CGT, subject to your financial transactions staying under this threshold. So let's look at the new CGT implementation. The CGT for 2025, which is now effective for 1st of January 2026, shifts to align with corporate tax of 30% and personal income tax rate of within 21 to 25% on specific assets disposed. If you look at the definition in the law, chargeable asset has now included trading in foreign currency, trading in digital assets, as well as other non-traditional instruments. Like we can see, Nigerian space have really adopted crypto heavily, and we can see from the number of transactions of the youth that traded in cryptocurrency and other digital instruments, really turned the focus of the regulators from SEC to other regulatory bodies to ensure that they set in place frameworks to ensure. Even currently today, SEC has a platform to regulate non-traditional instruments as well. So this new law really reflects the global investment realities, but it creates a more complex system because transactions traded in derivatives, digital currencies, shares, and other commodities on the floor of the stock exchange are more complex, and the respective valuation model for these instruments when they are traded really is more complex than you can think about, because if a particular CMO, capital market operator, needs to make his quarterly returns to the government, he needs to take into cognizance the respective peculiarities of each instrument. So for the new CGT compliance, the exemption threshold is 150 million per annum. That means that if you have a portfolio of maybe 30 million naira and you are a very active trader, maybe in a quarter you turn over 30 million twice, that's 60 million. So effectively, if you have a portfolio of 30 million and you are active, you can as well hit this threshold. Also, your gains should be under 10 million to enjoy this exemption. And we all know that this is really dependent on the trader itself and the market performance. So if the market is performing well and someone that holds a portfolio of 40 million naira trades and make a gain of 10 million naira, effectively they come into the bracket of compliance for capital gain tax. And if we look at the graduated tax rates for personal income tax, from 10 million and above gains, and the rate is between 21 and 25%. So effectively, you need to build your model in a way that whatever it's your aim for coming into the space of trading is achieved, in the sense that if you came into the market to get a 25% capital appreciation, and you know that effectively your entry and exit cost is between 2% and 4%, and the effective capital gains tax is 25% on your gain, and your gain is 25%, effectively you are going to suffer CGT of 6%. So 6% plus your total entry and exit costs in terms of stock broking charges and the likes, put together plus the 6.25%, that will come to about 11%. So if you have built your trading model to say, okay, I exit when my portfolio is showing me a 25% gain, so effectively your gain is within 10 and 15%. So everyone playing in this space now needs to recognize this fact and factor in the effect of CGT into their trading assumptions and model in order to guide against losses. So core implication for institutional investors, this revision signals a higher effective tax burden, especially for large-scale institutional players, while broadening the government's fiscal revenue base for national development. Now, if you look at towards the topmost right hand, you see the income band with respect to personal income tax. So 21% is for income band of between 12 million and 25 million. So effectively, if you make a gain in trading an instrument of let's say 10 million and above, so your CGT is about 21%. It will interest you to know also that even if you are in employment currently, if your employer files a return to the respective state internal revenue, that does not exonerate you from filing your returns. If you look carefully at the Nigerian Tax Administration Act, it's required of each individual taxpayer to file his return. So clearly you file your return for income from employment, salary, income from maybe your speaking engagement, maybe your side gig, income also from trading in shares, passive income like dividend and the likes. You also have to file that return. So we are moving into an era where you cannot just pay lip service to tax compliance. Each individual needs to step up his game, get to familiarize himself with the respective tax filing platform that we have, especially if you are in Lagos, you are resident in Lagos, your principal place of residence, your obligation is due to Lagos Internal Revenue Service. You need to familiarize yourself with the e-tax platform, while your employer will make returns on your pay as you earn on your salary. The government expects that you fully plug in your own returns, which would include income from all sources. You'll be having cases in the coming years where governments will just write you a letter and say, oh, your economic activity shows that you have carried out financial transaction of 200 million. Meanwhile, your employer has declared income of maybe 50 million to them. So, I mean, it will call to question your compliance with the relevant law. So, core implications for individual players in this space: you need to familiarize yourself with the respective law. You need to factor in the CGT implication into your trading model and assumption. You need to ensure that your exit position would really cover all these implications, because CGT is really on actual year basis. What do I mean? Your CMO would not deduct this at source. The government expects you to self-file your returns. And what do I mean by self-filing your returns? You need to come forward and, tell the relevant state internal revenue that this is what I have traded in, this is my gain, and this is what, I have gained from trading in instrument as well. So moving further on the key provision of the CGT, taxation of share disposal now has been specifically highlighted in the law. So previously, there was a specific exemption for charging CGT on share transaction. Now it has been specifically listed, including trading in foreign currencies, excluding the Nigerian naira. So people that trade digitally or electronically on the foreign currencies of other countries, your gains must be filed with the respective regulatory body. If you're a corporate, it's to the Nigerian Revenue Services. If you're an individual trader, it's to the respective state internal revenue service. Why do I say respective state internal revenue service? You could have a trader that principal place of residence is not Lagos. It could be Abuja, it could be Kwara, it could be Jigawa, and the likes. So the new CGT is quite robust. It recognizes portfolio rebalancing transaction. We have cases where big organizations carry out some sort of change of ownership in the shares of its company without consideration. In the previous CGT, that didn't really comprehensively cover that aspect, because a lot of multinationals took advantage of the loopholes in the law to exchange ownership of shares without remitting the respective returns to the respective regulatory body. So importantly, this act clearly defines chargeable assets and disposal and market value clearly, tying it also to the Nigerian trading platform. This also reduces the ambiguity in determining the respective capital gains tax on each financial transaction. Indirect disposals, related party transactions, areas previously prone to abuse has now been fully covered. So companies operating in multi-jurisdiction that usually, spin off a particular arm without consideration, because capital gains tax previously used to look at the fact that once you make a disposal, there will be the inflow of cash and the likes, while some companies do this disposal without any consideration, building in some sort of related party transaction that does not involve cash payer. So the CGT now has covered all those aspects. If you are going through merger, you are going through merger and acquisition and other forms of transactions, there's a need for your transactions to pass the test of the capital gains tax. Also, the tax mandates proper record keeping by the respective institutions. I have a slide on this that shows how the reporting is expected from brokers, registrars, custodians, even the banks as well. They have quarterly reports to do. Once your transaction hits the specific threshold for individuals and corporate, quarterly they are to integrate these returns and submit to the Nigerian Revenue Service. So clearly, even before you come forward and put your returns, take for instance, it's expected that individuals file their returns in January for the previous year, January to December. So returns for January to December 2024 is to be filed in January 2025. Before you come forward already, the government has already seen your economic activities and have a fair estimate of what you should have paid as personal income tax, as CGT, and as every other respective obligations to the government based on your economic transactions. So we are now moving, our regulatory landscape is now moving close to, compliance in the first world, like in Europe and the other regions. So for investors, really, if you look at the core implications, the new capital gains tax regime introduces challenges and opportunities. Why do I say challenges? There's challenges on both sides. taxpayers need to be conversant with the law. They need to be conversant of their expectations. Challenges on the side of the Nigerian Revenue Service has to do with the infrastructure and talent required to harness all the data that will be coming into their database now. Because if you have custodians, registrars, investment house giving you quarterly returns of transaction, that is a heavy dose of data that will be coming in. So they will need talent, they will need the technology to manage this information. The state internal revenue as well needs to, build capacity around that. So for retail investors, gains from stock disposal now attract CGT, especially if you fall outside the threshold that has been clearly spelled out, 10 million naira gain per year, trading above 150 million transactions. So don't look at it as a one-off transaction. Your portfolio can be worth 20 million naira, and if you are active on trading on the floor, if every quarter you turn over 20 million, you turn over 30 million, and you multiply that by 4 quarters, you could be close to hitting the threshold. So for investors, there's also an exemption. We'll also be talking about that in the next slide. Exemption, which includes the ability to roll over your gain in order not to fall eligible for capital gains tax, the ability to to harvest your losses from other instruments. Maybe you could have traded in gold, you could have traded in FX, and you incurred a loss. You can offset the loss with the gain you made in trading in shares, and the net position is what you are going to pay capital gains tax on as well. So moving further on the specific key provisions really that affect trading on the floor of the stock exchange, like I mentioned, the rollover reliefs, gains potentially exempted if they are promptly reinvested into replacement qualifying assets. So that basically means if you made a gain and before the end of the respective year, that gain was put back into trading. So if you dispose the shares of 40 million naira and maybe in the subsequent months you invested that 40 million back into the shares, effectively you are not going to pay capital gains tax. So the government is trying to to give some sort of soft landing, especially to small time traders and institutional investors as well. So for non-resident taxation, clearly now the law is moving away from taxing people based on their jurisdiction, because you could have somebody that sits in Dubai and trades in the floor of the stock exchange in Nigeria. You can have somebody that trades in crypto in Nigeria on the floor in the USA or the UK. So generally, tax bodies all over the world globally are moving away from the focus of taxing people based on their location, but it's now based on your economic activities as well. So gains realized from Nigerian assets is now subject, especially if those assets result in a gain and the respective instrument falls under the eligible chargeable asset as explicitly mentioned in the law. So applicable disposals include the sale of shares, securities, indirect transfers of Nigerian located assets. And like I mentioned earlier, organizations, multinationals, especially that deals in merger and acquisitions in various multi-locations around other countries that carry out a disposal without consideration are now subject to CGT. That has been specifically highlighted in the law. So they need to also build that into their own due diligence to ensure that whatever transaction they are entering into, these factors are considered as well. So core implication, really, we also need to look at that as well as we go ahead in trading. And we also need to be cautious before the end of the year. Every investor needs to review his portfolio and its trading pattern and revise its trading model to take into cognizance the effect of capital gains tax. So let's look at exemptions. So gains from disposal of shares by approved pension funds, unit trusts, and mutual funds remain exempted because these are institutions that trade on behalf of the beneficiary. So the law recognizes that fact. And so if you are an institutional investor here, whatever your gains is expected that those gains are distributed to the beneficiaries. For unit trusts, those that subscribe to the fund. For pension fund, These are the, those people that have signed off to put their contributory fund in with pension. So it's expected that those gains will be taxed in the hands of the respective beneficiary. Also, for exemptions for corporate restructuring and merger, the only exemption in the law, like I mentioned earlier, is that provided those transactions meet genuine business purpose tests, and this business purpose test clearly would be highlighted by the Nigerian Revenue Service, reviewed before they are granted this exemption. Because CGT does not hinder legitimate business reorganization, there is some level of business reorganization that really does not result in the disposal of shares. If a regulatory body has asked that a particular organization move from a particular registered state, take for instance, maybe from a limited to a holdco structure, clearly it passes the business purpose test. The reorganization does not involve a disposal for gain, but really to comply with specific regulatory requirements. So another exemption is investors would enjoy, which I have also mentioned, is the loss, harvesting loss from other trading instruments. So if you traded in derivatives or any other instruments, the law clearly grants you the right to offset those losses from your gains on other instruments, and you pay the net effective CGT on the gains if it crosses the threshold of 10 million naira, as well as if your trading transaction is in a year is above 150 million. So let's look at implications really. A lot of us on this call are worried because we hold significant position in various instruments, and would not want to exit because you have not hit your trading position in terms of your expectation, or whatever was your aims and objective for coming into that position. So investors will need to reassess asset allocation decisions, taking into account post-tax returns and holding period. Just as I've highlighted, if you look at the income tax band for 10 million naira gain and above, it starts at 21%. So if you are multiplying 21% on the gain of 20% position, that's about 4.5% really. You also need to build in the cost of entry and exit into this position. So if you enter into a position trading on the floor of the stock exchange, maybe your CMO charges you 1.5% or 2%. You exit as well, they charge you 2% again, maybe 4%, and you add it to the 4 or 5% that CGT, the implication of CGT on your 20% gain, that would effectively be moving northward of 10%. So if your aim is to exit a position when you have made a 20% gain, effectively you are going to walk home or walk away with a 10% gain. And if you don't want to walk away with a 10% gain, then you need to factor in all these facts into your trading model to ensure that whenever you exit, the gains you make corresponds with your expectations. Companies also involved in merger and acquisition, share buyback would face stricter reporting requirements with respect to the business purpose test. If the reorganization does not involve disposal for gain, the Nigerian Revenue Service will review those transactions as well to ensure that whatever reorganization that resulted in the disposal for no consideration really passed that business purpose test. So this reform basically would seem to dampen speculative trading, because people that are active in trading would really want to slow down and consider positions as well in order to enjoy the exemption threshold. So we'll see maybe at the early part of the year in 2026, and we'll see a slowdown in trading activity, because speculative trading would result to you in your transaction crossing the 150 million naira threshold, depending also on your portfolio as well. Not also for the drawdown, the drawbacks. We can also look at the benefit as well, long-term capital formation, which I believe also would benefit the trading market. That policy really is what the government is looking at. Not that the foreign portfolio investors just walk out of the the market whenever they feel like, because they are sensing uncertainty. So if they look at their position and they are willing to walk away with a 30% CGT, I believe that they would change their decision and, maintain position on the floor of the stock exchange. So for listed companies, they would experience indirect effect through changes in shareholders' behavior. Generally, everybody would review their trading model to ensure that they take advantage of the threshold as well, because CGT is now applicable on the shares and
The network will soon be back. Yes, yes, yes. Oh. So he will be back again in his network. So thank you, our audience. Before he comes back online, we can make use of the Q&A for our questions. If you have any questions, so we can make use of the Q&A to type in your questions while we wait for him to come back online. So just a brief recap of what from his presentation, he said categorically that the capital gain tax is not new to Nigeria system, that it was introduced 7 years after the independence. Okay, thank you. You are welcome, sir, Mr. Emmanuel.
okay. I'm not sure why I've changed internet service provider now. So I hope it's better. So I was just showing an highlight. I hope you can hear me. An highlight of the regulatory requirement of the Nigerian Revenue Service effective from 1st of January 2026. We could see financial institutions like banks, insurance, other financial institutions, transaction data, stockbroking firms, investment records. This quarterly returns is expected of them. So if you carry out cumulative monthly transaction threshold of 25 million every quarter, it's expected that these returns are made to the Nigerian Revenue Service. So effectively, capital market operators need to, redesign their technology and infrastructure to ensure timely, returns and filings are made to the Nigerian Revenue Service to avoid any penalty or fines, because the government has really increased significantly the penalties for non-compliance. I think the government is looking at 100% compliance. So in order to avoid this, you need to build your infrastructure and technology to be able to capture the data of new customers, their financial transactions that is above the threshold of 25 million cumulatively in a month. So if somebody that owns a portfolio of 5 million naira and is very much active on the floor, and that 5 million naira, he enters and exits positions that at the end of the day, in a month is 25 million, is 30 million, effectively you need to submit that returns to the Nigerian Revenue Service. For corporate body as well, cumulative trading of 100 million as well, returns need to be filed as well. Also, you are now expected to demand for tax identification number of every customer you trade in. So this is also for individual retail traders. Don't be worried when your CMO is asking you for your tax identification number. They just need to comply with the regulatory requirement as well. So you need to support them. They are not exposing you. Already your data is being seen by the government, so there's nothing to really be afraid of. So both parties need to be prepared. And the CMOs need to build their technology, build their talent to avoid the penalty. While the customers as well needs to, be open. If you have not provided your tax identification number, provide it to the your respective CMO in order for them to comply with the returns. So if you know your portfolio is 5 million and you don't want your data to go to the government, then you ensure that your cumulative trading in a quarter is under this, in a month is under this threshold, because the data will be accumulated on a quarterly basis. Your stockbroking firm would submit, your various other institutional bodies would also submit, like your registrars, especially when you buy instrument on the primary and the secondary market, like your bond, your commercial paper and the like. So you need to also consider all those facts as well. So let's look at regional comparison for us not to see it more like a one-sided effect in Nigeria. Although Nigeria, Uganda, and Rwanda really are top on the list of their capital gains tax, especially for corporate, you can see that Mauritius really exempts traders in shares from paying CGT. So effectively, Mauritius will be welcoming tax arbitrage in their region. So FPI that don't want to trade in Nigeria because of the capital gains tax would probably move their portfolio to Mauritius if the market is robust enough to welcome them. So when you look at it, you see that this CGT is not really new in the sub-Saharan region. You can see South Africa at 21.6%, Kenya at 15%, Tanzania 10%, even Rwanda, that seems to be a country that welcomes investment. CGT's rate is at 30% as well. So if you are a global player in the market, you need to also consider all these factors if you need to move your portfolio as well. One thing as an individual trader really gives you some sort of a lower rate, because if you look at the income band when I presented earlier, the CGT rate has been aligned with the personal income tax income band rate, which is progressive and graduated. So for between 10 million to 15 million, the rate is 21%. When you hit the 50 million naira threshold of gain, then it becomes 25%. So effectively for individuals, it's capped at 25%. So it looks as if trading as an individual is more tax beneficial than trading as a corporate organization, because effectively as a corporate organization, your CGT is 30%, which has been aligned with the company income tax rate, which I believe is not new to institutional investors, because we also have various clients in this space that has been really remitting 30% on their capital gains. It wasn't called capital gains because if you are a dealer and you deal in shares, whatever gain you make, you add it to your income, and at the end of the day, you are paying 30% on your profits, which in that profit, your capital gains is inclusive of it. So technically, corporate dealers in this space have really been paying 30%, because right now it's just like changing it from company income tax to capital gains tax. And once that income class has undergone capital gains tax, it would not be considered for company income tax. So for me, institutional investors really have been complying. It's just that they need to now ensure that the quarterly reportings are met, because the government has really heightened the penalties and fine, and you don't want to be wasting your funds complying, paying penalties for non-compliance. So your talent, your technology needs to be aligned with the law. We have less than 2 months to the commencement of this, and I believe organizations should look at that as well. So impact analysis for Nigeria and investors, benefits for Nigeria, we see accelerated revenue growth. CGT will contribute to the total revenue that the government will earn, even though when you listen to various presentations made by the chairman of the Fiscal tax policy, Mr. Taiwo Oyedele, is making it to, although they are speaking on data, they believe that 95% and above would not suffer capital gains tax. For me, I think it's an exaggeration, because if an average individual investor that owns a portfolio of 10 million naira, valuation of 10 million, and is active on the floor, trades every month, I believe you will be able to cross that threshold accordingly. So one other benefit is the enhanced tax equity. Nigeria is a member of the OECD, and there have been various pushes in the global space to ensure there's tax equity. Basically, they want to avoid tax arbitrage. They don't want people to be moving funds among jurisdictions and regions to take advantage of this, because in a couple of first world countries, CGT really has been existing, even at 25 and 30% rate. So the government is looking to enhance tax equity as well. Market stability, we've talked about that as well. Because of this, a couple of investors would want to rethink and recalibrate their trading model. So investors who are saying, oh, I will exit a position at 25% gain, would need to recalibrate and probably move it up to 35 or 40%. And moving it up to 35 or 40% would mean that you would hold position for a longer period, depending on how the market trend towards. So implication for investors as well, you have reduced after tax returns. Effectively, your net cash gain after considering CGT would drop. That needs to be considered as well. There will be strategic portfolio rebalancing. Intelligent investors would want to put their funds in long-term investment where they will get significant capital appreciation in view of the CGT as well. And potential liquidity impacts, yes, the market will experience a temporary dip, especially maybe in the quarter one and quarter two, because a couple of players will be trying to understand the market space now. So particularly in equity segments, even though our market develop give you an idea of how compliance with the CGT. Great. I've been very mindful in trading in foreign currency, crypto, and other digital and electronic currency. If you look at the SEC guideline, on digital instrument, you'll see that SEC has really started accrediting VASP, that's the virtual asset service providers. These are people that more like you have your CMOs, your capital market operators. These are people that operate in that space, that manages the platform for trading in digital currencies, digital coins, and all the likes. These are more like non-traditional instruments. So the definition of chargeable asset has clearly spelled out this. So I don't want to be using the word shares. So Grace could trade in crypto, Grace could trade in FX electronically, not in cash. Grace could trade in shares and every other chargeable asset as defined by the law. So if Grace trades in chargeable asset for 5 million and sold them later for 7 million against his 2 million, clearly this sale is below the 150 million naira annual threshold for the exemption. So clearly this means that Grace is fully exempted from the capital gains tax. Mind you, my assumption here is that Grace traded in these shares for 12 months. That's the cycle. So if Grace trade one-off and her gains is 2 million, that means she's fully exempted. And now let's look at scenario two. Scenario two is Mr. Active. Mr. Active sold chargeable asset worth 200 million that he bought for 160 million. His gain is 40 million. If you look clearly at this part, you'll see that the 200 million crosses the 150 million naira threshold. The gain also crosses the 10 million naira threshold per annum. But if you read further, you see that because his total sales exceeds the 150 million, CGT applies. At the 25% personal income tax rate, if you look at the personal income tax band, as I mentioned in my earlier slide, income band from 50 million and above is capped at 25%. So he will suffer CGT at 25%, and that's 10 million naira. And this Mr. Active has simulated his trading model, and he doesn't want to pay CGT of 10 million naira. He reinvests this 120 million proceed of, back into the floor. So now he's going to pay CGT on the eligible portion. This is now a benefit because in the law grants proportional adjustment for reinvestment and gain. So since Mr. Active has reinvested the sum of 120 million, the balance 80 million is inclusive of gain. So 80 million all over 200 million, which is the proceed from the initial sale of the chargeable asset multiplied by the gain of 20 million. He's going to pay the CGT based on that portion as well. So that is also a benefit really that investors need to consider. So if you enter a position in January and you have a gain of above the threshold, you can decide to enter a position before the end of the year. So by the time you are filing your returns, you would have put back your gain into the market. And when the returns are going in, it will show that your gain is below the threshold and you will be fully exempted from CGT. This is scenario 3. Mr. Active sold chargeable asset worth 200 million that he bought for 160 million. His gain is 40 million. And because his total sales exceeds 150 million, CGT applies. At the 25% personal income tax rate, that's 10 million naira CGT, which is due to be paid to the state, the relevant state internal revenue. If he reinvests the 180 million of the proceeds in the same year, now he only pays CGT on the portion not reinvested, which is the 20 million, which is the difference between 200 million and 180 million reinvested, all over 200 million multiplied by a gain of 40 million, multiply also by the 25% personal income tax rate band for that income class. That means you'll be paying 10 million naira CGT. Now let's look at scenario 4 for a corporate investor. Blue Rock Investment Limited bought chargeable assets worth 400 million and sold them 2 years later for 600 million. So effectively, in the first 2 years, the assumption here is that Blue Rock Investment did not trade in any other instrument in the 2 years before it was sold. So in those 2 years, he didn't pay any CGT. So in the year he sold it for 600 million, his gain was 200 million. And under the new rule, company income tax is 20% for CGT, and that's 60 million. But if the company reinvests 500 million of the sales proceeds of 600 million, that will mean that the available proceed is 100 million, and that will be taxable by 30%. So these are scenarios really which has put together various models and approach that investors trading as an individual and as a corporate organization can consider to do before they exit positions, before they enter a position. And you all know that while you are entering those positions, already your data is going to the Nigerian Revenue Service. So you want to be careful that whatever position you are entering, especially as an institutional investor where you are holding funds, on behalf of beneficiaries, you need to be careful in order not to fall within the high band as well. So let's look at another scenario, scenario 5. Mr. David, an experienced investor, sold some chargeable assets in 2026 for 200 million, which he originally bought for 230 million. So here is a case of tax harvesting. Harvesting your losses from various chargeable assets. So it results to a loss of 30 million. Although the total sales proceed exceeds the 150 million threshold for eligible CGT transaction, CGT would not apply because there is no gain from this sale. As if you look at the CGT, you see that CGT is based on gain and profit as well. So let's look also at the final scenario, scenario 6, Mrs. Tolu. Mrs. Tolu is an active investor, sold 2 chargeable assets on the assumption that maybe one is shares and one is crypto or one is derivatives, and one at a gain and another at a loss. She made a gain of 30 million on asset A, but incurred a 15 million loss on asset B. Under the CGT rule, she can offset her loss against her gain, resulting in a net chargeable gain of 15 million naira, which is above the threshold gain, the exemption threshold of 10 million. So with the tax rate of 25%, her CGT liability drops to 3.75 million rather than 7.5 million, which should have been on the 30 million naira gain. So here is a case of tax loss harvesting, where your net position is what you subject to capital gains tax. Now let's look at recommendation. You need to review your portfolio, which I have mentioned earlier. Your holding position before the end of the year, you need to review it as you move into 2026 to ensure that you are sitting on a position that is beneficial to you in consideration of the CGT, especially as an individual trader. You need to engage your tax advisors. You need to familiarize yourself with the respective digital platform for filing returns. In Nigeria presently, tax compliance is now digitized. You can file your returns yourself on the e-tax platform, especially for Lagos State and a couple of other states in Nigeria like Ogun State, Abuja, and some other regions as well in Nigeria. So yes, advocacy for more clarity is going on presently. I think this week as well, we saw feedback from the meeting with Mr. Taiwo Edeli and some foreign investors as well, who are trying to get to understand properly, how, the impact. And if you look at the contribution of foreign portfolio investors with respect to domestic traders, you see domestic traders are really much more than the foreign portfolio investors. So effectively, this tax the burden is more on the traders in this jurisdiction as well. So investor education, just like we are doing here, you need to get more investor education, especially for the CMO. The CMO that put together this as well is trying to ensure that their clients as well are well prepared for this regulatory compliance as well. The CGT reform demands immediate adaptation of strategies to protect returns. Yes, the government is looking to shore up its revenue. Individual investors also needs to protect their own revenue and liquidity as well. For compliance and optimization strategies, one, you need to enhance record keeping, maintain accurate and detailed record of your asset cost and basis, because this will help you in your returns to the relevant state's internal revenue. You need to document your disposal. You need to manage your holding period. I don't need to speak too much about this. If you are an active trader, you already understand how to manage your holding period psychologically and emotionally. You need to be proactive in tax optimization, utilizing reinvestment reliefs. Yes, you can cross the threshold in Q1. Nothing stops you from entering a position in Q4 in order to, to fall under the exempt category. If you are trading in Q1, Q2, Q3, and you have exceeded the threshold, maybe your portfolio transaction, your activity is about 400 million, nothing stops you from going back into a position in shares and other instruments to ensure that the government does not take you as part of the eligible taxpayer for CGT as well, because both parties are looking on how to protect themselves. So for market outlook, short-term volatility, we would experience that. In the medium to long term, we'll see stabilization, we'll see physical strength, which the Nigerian government is looking at. They want to ensure that they are able to ensure the stability in the market. We could see cases in the previous past where maybe before the elections, foreign portfolio investors would reduce their position and exit the market. And I think this would also reduce that effect as well. So I guess I'm done here. So we'll now move to the question and answer section. Thank you very much for your attention.
Thank you, Mr. Emmanuel, for that powerful and exciting section. So it has been really impactful. So thank you so much. So we have some questions from our audience, which I would like you to answer, sir. The first question is that, thanks so much. It is clear we are entering a complex terrain. Meanwhile, with dividend being taxed, that's the first question we're having from our audience. With dividend being taxed, I want you to, there's a difference between capital appreciation and dividend income. So I want you to differentiate the withholding tax and the capital gain tax. I want you to give more insights to that.
Thank you very much. I think the concern of the person is not far-fetched. Currently, dividend is taxed at source. So before you receive your dividend in your bank account, you would have been subjected to 10% withholding tax on your dividend before you receive it. So dividend is presently being taxed in Nigeria. Dividend is not subjected to capital gains tax. Capital gains tax are on, let me use the word capital appreciation. Capital appreciation. So if you invest in shares at 1 naira and the shares is 2 naira at the point of disposal or exit, you have effectively received the gain on the disposal. So you'll be subject to CGT as an individual at the respective income band rate. If you hold the position for more than 1 year, you probably would have received dividend as well. So your dividend would not be taxed. Even while you are filing your returns with the respective state internal revenue, the law defines dividend as frank investment income. What that clearly means is that that income will not be taxed anymore. So if you receive a dividend of maybe 200 million naira, that will not be taxed. The whole money belongs to you. Effectively, you would have suffered withholding tax of 10% on that dividend as well.
Wonderful answer. Another question from our audience. Can you please share a copy of the webinar with us? I believe.
Oh yes. Yeah, I would share my slide with Lead Capital.
We send it to our audience after the webinar. So people that register via their email, we make sure that everyone that attended section have a copy of the presentation. So we have another question here from our audience. What is the market player going to engage the presidency for the potential banana peel that can wipe off the success of this administration in terms of the all-share index groups? What do you see is that in terms of that, the impact of this on the final success of this administration? So what is the impact? Do you think it has a negative impact of the share index group that have been recorded so far?
So because large institutional investors already are paying 30% company income tax on their capital gains, I do not see a significant long-term effect on the volume of trade or on activities. What I see initially in the short term is more like stability in positions, maybe a lower volume of activities, maybe in Q1, Q2. Clearly, everybody is trying to understand the impact or the effect that how this, how the CGT would, impact their position, especially when you are in a position that is in the negative, you are unwilling to exit currently. You are unwilling to exit. But a lot of people will just exit and wait and see, how will this thing play out. Some people that are in the negative will want to hold position and see how it play out. So we'll see in the short term, we'll see maybe a little bit of cautious trading, less of frequent entry and exit by players in the market. But for me, for institutional investors, they have been paying 30% company income tax rate on their capital gains tax. So right now, effective for 2026, capital gains will not be subject to company income tax, will now be subjected to capital gains. So for me, the institutional investors really, especially for dealers, dealing brokers, and a couple of other CMOs, they themselves are not worried because they've already felt will I use the word, they've beaten the bullet already. So they've been paying 30% on their capital gains as well. So I think it's more for individual investors whom fall outside the exempted threshold that would really be considering the effective 25% on their gain.
Thank you. Thank you for that wonderful answer. So we have another question here from our guest, Mr. Kingston. Exactly, what's the impact of the new tax on Nigerian treasury? So on money market instrument, what is the impact of the new NCA on the Nigerian treasury?
Okay, thank you very much. That's a good question. Already, Nigerian treasury bills that you purchase primarily on the floor as an instrument has been exempted already. So your treasury bills gives you your coupon and your returns. That is not subject to capital gains tax. Already there's a exemption for treasury bills, especially the one you purchase from the primary market through CBN. That exemption will stand. Your treasury bills, the obligation on the treasury bill instrument is for you to receive quarterly or, as stated, regular interest or coupon on them. So clearly, that's not capital appreciation.
Okay. And the commercial paper, what do you see? Commercial papers they're not issued by government. So what do you see in commercial paper?
Yes, commercial paper through are more like fixed instruments. In the industry now, you see that a lot of private organizations really have been, you see some organizations have been issuing those instruments. The obligation on those instruments as well are more like interest and coupon. They don't appreciate. They don't have capital appreciation. So therefore, it's not subject to CGT.
That's the point. So, but audience, any investment in money market will have a position or just the dividend income or the income that has to do with interest or dividend income are not subject to accounting tax. Thank you for that. For separating between the capital gain tax and the withholding tax. I think that our audience have seen that. So that means that for every investment done on the money market, you are subjected to only withholding tax. How about how good that?
Exactly.
That's fine. So withholding tax has to do with the money market investments in 1 year instrument.
There are also
So
some instrument that has been exempted from withholding tax, especially treasury bills from primary market from the CBN through the federal government.
Okay, that's fine. So I believe that this also answers the questions here. Does capital gain tax affect investment in money market funds? What about the money market fund now?
Yes, so that's a good question. The law clearly stated that those directors, they are like trustees holding investments for specific purposes for distribution to the beneficiaries. The tax, the capital gains will be done in the hands of the beneficiary. So take, for instance, an ABC Fund Investment PLC receive money, collective investment scheme, CIS, collective investment scheme, receives money from investors, invest it, receive dividend, receive interest. They are expected to distribute it to the unit holders in full. So therefore, they are not subject to this respective CGT in the hands of the trustees. They are called trustees. They are holding those collective investment on behalf of beneficiaries. So the beneficiaries at the point where they have received it will now, comply with CGT as well with respect to capital gains.
Okay, thank you. So we have a question here. It seems that the turnover gain to be mixed up in this presentation. What the audience, our then is trying to clarify that there is a need from the calculation and the turnover that split the cost is also being inclusive in the target tax. Let me clarify that I invested 10 million, I bought a stock for 10 million, and I sold at 12 million, making a profit of 2 million. So will the old 12 million be taxed or just the gain of 2 million that will be considered? I want to clarify that for our audience.
Okay, thank you very much. So capital gains tax is on gains. So if I bring in 5 million naira, I give 5 million to my stockbroker and he purchases shares worth 5 million naira, and I sit back for 6 months and the shares appreciates in value to 7 million from 5 million. Capital gains tax is on the gains of 2 million, which is the difference between the sales proceed of 7 million deducted from the cost of investment of 5 million. Now, the assumption is that your cost is inclusive of your transaction cost. Why do I say that? Because the CGT gives you the right to offset your expenses, your stockbroking fee, CSCS fee, and the likes. All those transactional costs you incur in acquiring these instruments, you have the right to offset it. But if you trade with, I mean, Lead Capital, take for instance, you buy a shares worth 5 million. By the time they are disclosing this value in the valuation report on their portal, they would have adjusted your cost price and call it average price, which would have been considered the transaction cost.
Okay,
I hope I was
fine.
able to.
Yeah, that's. So I have another question here. Great presentation. So are you going to have the recording of it? Yes, we make sure we send it out to all
Okay.
our registered audience after the webinar. We send it out. And we have a question here. Okay, another question: will it be possible for Hasba to get access to the? Yes, we make sure we send it to all the registered audience that we are making the webinar that are registered for the program. As an individual, how do we remit our account against that it's not documented at the close? And so that's a wonderful question. As an individual, how do we remit our account against that it's not deducted at so?
So that's a very good question. The Finance Act of 2021 really expanded compliance with personal income tax. In the year that was the act came in, it required individual taxpayer now I'm referring to file their own return aside from the returns that from employment that the employer files on behalf of the employee. So generally, everybody is I'm sure everybody on this call, let me just assume that a couple of people on this call are in employment. They receive salary, they invest their money. They don't even bother themselves about filing their returns. They don't have nothing to do with the Lagos State Internal Revenue, with the assumption that they are residents in Lagos State. The employer files the returns every January of the year and says, oh, this is the person's salary, this is what the person has, oh, this is what we have deducted, and here is the check for the payment. And all is well and good. But now the individuals would need to now file their own return aside from that returns that the employer filed on behalf of the employee. Why? Because the employer is only filing one category of income, employment income. The law says that you have income from other sources, income from trading, income from investment, income from all other sources, people that have speaking engagement, people that have businesses, established businesses and they are still in employment. You are supposed to come forward and file your returns because automatically the government is seeing your transaction. So for Lagos State, there's what they call the e-tax platform. On that e-tax platform, once you key in your tax identification number, which is usually starts with the code N, that's for individual, N dash your number. If you key it in, put in your code, you see your platform, you see your back end where you can file your returns. And from that back end, you see the returns that your employer has also filed. So we are now moving into, the how it's done in first world, where each individual files their return. And Lagos State is in the forefront of all this digital innovation. I know also Ogun State is also compliant. Federal Capital Territory is also compliant. Some other states are coming up also. So that's why I talked about challenges and opportunities. On the side of the government as well, there are challenges. Some other states like Zamfara and other regions in the north may not have caught up with technological deployment and innovation, but somehow they will come around. So every trader needs to familiarize themselves, especially if you're in Lagos State, you're resident in Lagos State, you need to familiarize yourself with the e-tax platform of the Lagos Internal Revenue, LIRS. You need to log in, you need to see what your employer is filing for you if you're in employment. If you own a business as well, you also need to set up your own platform because if you own a business, you are also expected that you pay your personal income tax as well.
So I have another question. It's been very interactive section on our audience. We have a lot of questions. So is there any tax rate difference for owning chargeable assets for a long time? So the audience wants to see what is the benefit of holding doing short or long on assets? That the strategy.
So this is not a straightforward question to hold chargeable assets for a long or short term. So that depends on your portfolio valuation. If your portfolio is 5 million, you can exit and you can be very much active. Let's assume you trade once in a month. 5 million times 12 months is about 60 million. So that means your financial transaction, that is like a bank statement that shows your exit and entry position. It says, oh, Mr. A's financial transaction is 60 million. That is under the threshold of 150 million naira per annum. So effectively, you're exempted. So it's not a straightforward question. So you would need to recalibrate your trading model. What do I mean by your trading model? Everybody comes into the market with a aim. Me, for instance, I might say, okay, once a particular stock is doing 30% from the cost, I'm good. My entry and exit cost is about 4%. I walk away with maybe 35% if I'm looking at 40%. If I'm looking at 30%, entry exit is 4%. I walk away with 20-something percent. If CGT is if my position is subject to CGT effectively 25% multiplied by maybe a gain of 20%, that's about 5-6%. So effectively, the cost of entry and exit, including CGT, is about lower band, maybe 10%. So it's not a straightforward question that will say, oh, hold your shares for a long period, don't hold it for a long period. Every trader should have a trading model. You should have a trading model where you would have, built together a scenario and said, okay, if I'm buying XYZ, I'm holding it for XYZ period. And when it hits that point, I exit, I take my gain, I move on. So it's not a yes or no question.
For the answer. So what's the impact of the new tax law that are in money market? This has been answered earlier. Therefore,
Yes.
the capital is not inclusive to the money market investment since we don't have capital gain. We only have income gain. So the withholding tax will be applied to investments, not the money markets. So that's fine. So we have another question here. I bought a share 10 years ago for 200 million and sell in 2026 for 250 million. Will I be taxed for the 50 million, not putting into consideration the capital position between the 11 years? What the audience want to do is that for the purchases done before 2026, and then it taxes.
So effectively, 1st of January 2026, quarter one, your stockbroker sends a quarter returns and says you hold a position of 200 million. So effectively, if you bought the shares 10 years ago, the returns have been put in that shows that, oh, this person is a customer of this stockbroking firm, holds a position of this. When you now exit the position, automatically capital gains comes in. So income tax is based on your transaction. So if you exit in 2026 for a position you entered 10 years ago, or automatically you are eligible to make remittances for capital gains.
That's fine. So we have another question. Yeah. Investments. They're going to be a double tax for them in the first year and also in their contract when they report to them for people that are that's for the tax.
Sorry, I didn't get that question.
For the people that are in diaspora, what is the impact of the new tax law? They can get tax.
So yes, for those in the diaspora, yes, if you look at the definition of your place of residence, yes, you are not residing in Nigeria, but if you hold position in instruments domiciled in Nigeria, you are eligible to comply with the capital gains tax. So if you are in Canada, take for instance, and you are investing in the Nigerian stock exchange, effectively you are earning income in this jurisdiction. So you will need to comply with the capital gains tax. Don't forget that even the companies that deduct withholding tax on your dividend would remit the dividend in the name of the taxpayer's ID. So effectively, you have a taxpayer ID in Nigeria. You are benefiting from economic activity in Nigeria, so you are subject to CGT in Nigeria, despite the fact that you are not resident in Nigeria.
Okay,
So
So
the law has really been shifting to what they call economic activity and less of jurisdiction or place of residence.
okay, thank you. So does the exemption of withholding tax on primary Nigerian treasury be applied to secondary market transactions for people that are buying their treasury at the secondary market? What is the impact of the withholding tax? Will they be subjected to withholding tax for now just gone for the option markets?
So if you are buying your treasury bills, so effectively, when you are buying those treasury bills from the secondary market, those institutional investors are also going back to the primary market to acquire those treasury bills that they hold in lump sum for their various beneficiaries. So effectively, you are going to get that benefit.
Okay. So we have a question. In some country, there's a tax rate difference for short versus long-term capital gain. Here's the question: is there one rate or varying rates? You pay less for long-time holding and short for short-time holding. Is this applicable to the new capital gain tax law?
Okay, so in Nigeria, there's no short rate for holding or short for long period. Is one rate. For corporates, it's 30%. For individuals, it's in line with the income band, and the highest band is 25%. So effectively between 21 and 25% for individuals. So if you are 50 million and above, it's 25%.
Okay, we have our question from our client that are in that they're asking, how does one obtain the tax ID if one is not residing in Nigeria? The income generated from the capital market is not close to the treasury.
Okay, that's a good question. So you can log into LRS platform. Once you put in your BVN and your name and the likes and your email, they automatically register you, send you your tax payer ID to your email address. You don't need to be physically present in Nigeria to have a taxpayer ID.
Thank you for the last question, last but not the least. If you date on my position before I enter in 2025 to create a new entry position, will that impact my capital gain tax? So the client will want to bring that. Okay, let me sell up.
This is a good question, very good question. I will assume that you're an individual, you're not a corporate organization. So if you're an individual, income tax law is based on actual year basis. So if you exit your position in December of 2025, by virtue of the extension of the effective date for the tax, it's 1st of January 2026. So effectively, you are starting the year afresh. So when you enter a position in 2026, that's when you will now be subjected to CGT. So for corporate organizations, taxation is done based on preceding year basis. So effectively in 2026, you will pay tax on 2025 financial year.
That's a question. And we have another question again. It has a very impactful section and the engagement form of our client. They like to be informed about the capital gain tax. So we have the last question. I promise this is going to be the last question. In determining the cost of the share sooner, we apply average cost of first staff or last in last out to determine the average cost. So what is the cost implication, or is it about the gain or the price of the person?
Okay, so for me, this is a complex question. It's not something from experience. Your portfolio is always valued based on the average cost. So if you enter a position, let's say UBA at 20 naira, and you enter another position at 30 naira, your portfolio will show the average. And whatever your CMO is reporting to the Nigerian Revenue Service also will determine how the transaction will be eligible for CGT. But from a point of a prudent investor, you want to say, okay, I bought 10,000 units at 20 naira, and I'm disposing that 10,000 unit, not the additional 10,000 unit I bought at 30 naira. So those are what they call technicalities. So he can bring forward his, what do you call it? His transaction information and say, look, I bought this in day one at this rate. This is the cost that I will need to use. So if you look at my slide, I think slide 18, I talked about reporting documentation of disposal. I don't have the right to share what I've showed you. If you look at slide 17, I talked of prompt disposal reporting. So you need to document your transactions, especially if you're an active trader on the floor of the stock exchange. So if you buy UBA at 20 naira and you bought another 10,000 units at 30 naira and you want to dispose that first 10 units, all well and good. The platform is now digital, so it lumps up all your units, lumps up all your value, determines your average cost, and puts it on the platform. So if your broker has reported average cost to the Nigerian Revenue Service, it's left to you to come forward to say, okay, this is the transaction details. I bought UB at 10,000 units at 20 naira. I'm disposing these 10,000 units. Average cost cannot be used. This is the so those are technicalities that really will be considered and granted by the tax authority.
So thank you, Mr. Emmanuel. This has been interactive and insightful. As even as a tax expert, I've really gained from the weight of your experience, and you have provided clarity to some gray areas in the new tax law. And I only hope that even our investors have been blessed and been informed with this section. So thank you, sir, for that insightful section. We are very grateful. So we look forward for another time again next week with you, sir. I will promise all our audience that registered for the vision with the program, they will receive the presentation and the recording of the session with whom we can have round of talk. I'll be calling on Mr. Shafiq Ashfaq. You are welcome, sir.
Okay, thank you very much. Thank you, Mr. Emmanuel.
Thank you for having me.
Thank you for doing justice to this talk. For also answering all the questions. It's been very interesting. You have actually made my day, and I also believe that for the attendees too, you have actually made their day, because the presentation was very informative, engaging, thought-provoking. So at Mint Capital, we appreciate you, and we are deeply thankful to our guest speaker, that's Mr. Emmanuel again, for today's insightful webinar and sharing his wealth of experience, his knowledge in such engaging and then in a relatable way. So we believe that some of the questions that have been asked will be addressed. So we say big thank you to you for creating time, for your limited time to do justice to this topic. So we say thank you to you once again. And to our audience, we also like to extend our heartfelt gratitude for your time. Anytime we have a program, you create your limited time to do this program, and we appreciate you. And we believe that this program, this webinar, is going to guide you in taking some investment decision beyond the year 2026. And then we also try as much as possible. There's a pause to also arrange another webinar for those who actually miss this opportunity. We try as much as possible to also come on board and bring another topic that is going to relate in such a way that during 2026 you can make a best investment decision that can add value to your portfolio. So once again, I want to say thank you to you, Mr. Emmanuel, for doing justice to this topic and for your time. Our audience, thank you once again. We'll give you that assurance that we're going to send this link to all the attendees. So thank you very much. Enjoy the rest of your day. So Mr. Emmanuel, thank you once again.
Thank you for having me.
Bye for now.